Hello, and welcome to the property market update for New South Wales at the ACT from realestate.com.au. I'm Luc Redman, an economist here at REA Group, and I'll be taking you through the property market within those two regions and what we're currently seeing and our point of view and what's kind of going on in the economy more broadly. To that end, we'll start with economic conditions before moving into the current housing market and the conditions that are currently there. Then we'll flow into something that's quite topical right now, being investor activity and budget changes. And then we'll finish off with a bit of an outlook of where we expect prices, interest rates, and things in the economy to move a bit more generally going forward. Starting off with economic conditions, inflation remains pretty persistent within the Australian economy, and that's kind of unlikely to change over the next 6 months. So what we're currently looking at here is the Consumer Price Index, which is a bit more of a preferred measure of household inflation within the economy. There are two types of series that we're looking at here. So the red line is headline CPI, which tends to be what households kind of feel in terms of price movements more generally. That tends to be what the media will report in terms of CPI movement, and that's kind of that red line there. When we look at the light blue line, the trim mean, that's the RBA's preferred measure of inflation within the economy. And essentially what trim mean does is it takes the top 15% of price movements and the bottom 15% of price movements to get more of a core inflationary movement within the economy of the basket of goods that households kind of consume. As you can see, that helps to remove volatility within the indexes. So when you look at the light blue line, it's always either below the red line when it's going up or above it when it's going down. So we kind of get a bit more of a core movement of price levels. On each of those, the dashed line, the light blue dashed line and the red dashed line, those are forecasts from the RBA after their last interest rate meeting around where they expect inflation to move to over the short to medium term. As you can see from those, it's unlikely that headline will kind of reach back to the target band, that grey area that the RBA prefers, that 2 to 3% target band, within the next 6 months or so. And it's more likely into the middle of 2027 or later in 2027 that we actually see both of these return to the target band and the RBA kind of be happy with where inflation is at. And the main reason behind this is actually down to domestically driven inflation. So the chart that we're looking at here is broken up, is the headline CPI, the series that you saw in the last slide, broken down into two different types. Non-tradables, which is kind of domestically driven inflation, and tradables, which is internationally driven prices. So the red line is domestically driven inflation or non-tradables, and that represents about 2/3 of the CPI basket. Tradables, the other third. Tradables tends to be things like TVs that whose prices are kind of, or oil or fuel, whose prices tend to be driven by international markets. Non-tradables, the 2/3 of the basket, they tend to be more domestically driven prices. So that are factors that kind of are dictated by Australian policy or just things that we can purely only make and goods and services that we can purely only make within Australia. So when you think about non-tradables, things like electricity, rents, pharmaceuticals, and hairdressing are kind of examples of what non-tradables are. Whereas we see tradables, it's things like TVs, oil, things that we can buy and sell on the international market. And when you look at the red line here, it hasn't really ever returned to the target band that the RBA is after. So when they started cutting interest rates, it was just floating above that band, and tradables was well and truly below it, as you can see, the light blue line just below. And what ended up happening was when the RBA cut rates, we actually saw that non-tradables line tick up to where we are kind of right now, to about 5% and a bit below currently at about 4.7. And that essentially meant that there was a lot of stickiness within the domestic economy. And the RBA talked about this by saying that there was capacity constraints, meaning that we can't make enough goods and services to satisfy our current demands. And that means that they require slowing a demand until our supply can catch up. The light blue line there, you see quite a large spike towards the end of that series and then a drop off again. And that's mostly driven by the war in Iran and the oil prices that we've currently seen. So that big jump up was the significant increase in oil prices that occurred when the invasion first happened, and we saw that at the petrol pump. And then the drop back down is mostly driven by two main factors. One is oil prices had eased quite significantly into that month, and that may or may not be the case right now. And strong policy response by the government. So things like halving the excise, free public transport, those sorts of things that kind of took a lot of pressure off the demand for those sorts of tradables. And that's why we saw that cool back down a little bit. Ultimately, as a response to that, the RBA did hike interest rates. And what we're looking at here is mortgage rates for new owner occupiers as a variable rate. And essentially what we see is in recent history, we're kind of level with the most recent high, which we saw in 2023, 2024, and even a bit into 25 before the cuts occurred. And essentially we're back up at that mark right now at 6.23% for the average new owner occupier variable rate. When we take a longer view of that across all of the RBA's interest rates, we're kind of at mortgage rates seen in 2011, 2012 right now, but something that hasn't really been seen for the last 14, 13 years outside of the recent high. And that's purely to try and slow demand within the economy to bring those sorts of things like that domestically driven inflation back towards the target band. And they do that by increasing the cost of borrowing. So when they increase the cost of borrowing, people have to pay more money to the bank and have less to spend. And that just slows a lot of demand, which the RBA is aiming to mean that supply, particularly domestic supply, can catch up to that demand. That has implications for the unemployment rate. So when the unemployment rate and inflation have an inverse relationship. So when unemployment rises, inflation tends to fall. When inflation rises, unemployment tends to fall. And that's kind of true globally. What we see is when demand slows, inflation tends to slow down, and that means unemployment tends to rise. What we're currently looking at here is the Australian unemployment rate going back to the 1970s in the red line. And what you actually notice is we're actually still at quite a low unemployment rate level historically. Outside of just prior to the global financial crisis in 2008, we're kind of at a record low still, even with that light blue line, which is the RBA's forecast for unemployment, which is expected to rise. We're still at a really historically low level, which meant there was a lot of tightness within the labour market, which meant wages and labour costs kind of grew in turn with that. So we kind of saw that it's some strong wage growth recently and in the last few years, partly driven by a lot of public sector spending, but also partly due to the tightness of the labour market and demand for workers within the economy. Those wages, however, didn't necessarily keep up with inflation. So whilst households might have had wage gains, nominal wage gains, they didn't actually have real wage gains. So wage gains that essentially outstripped the rate of inflation. Those stronger labour market conditions supported a fair amount of economic activity within the economy, but that was in part a lot of public sector activity until quite recently where we've seen the private sector grow a lot more and expand and spending increase. So what we're looking at here is GDP growth and its contributions on an annual basis going back from 2015. And the black line is the aggregate figure, and then the components are in the bars. So the red being net exports and other, the light blue being private, and purple being public. And as you can see, particularly for net exports, it moves around a lot. And that has things to do with our our exchange rate, how commodity markets are doing, and the general skewedness of our economy and structure as to what we export versus what we import and how our dollars are going relative usually to the US dollar. What we see here in the purple in public sector, that's been relatively consistent and spending has been quite strong. That's kind of been the case since about 2015, where we've seen a lot of strong spending from state governments for infrastructure projects and federal government in terms of operationally. We saw during COVID quite a drop off in the private sector, which strongly rebounded with a lot of fiscal stimulus and support, which contributed to the inflationary problem that we kind of still have now, with a lot of money kicking around the economy and very low interest rates, which spurred a lot of spending and investment. The recent uptick that we've kind of seen recently in the private sector is really driven by data center investment that's kind of occurring within the economy. So it kind of paints a bit of a better picture of the economy than what's actually kind of going on. So large data center investment and that expenditure on the builds and the infrastructure and the machinery, that's been growing quite rapidly in the last couple of quarters, and that's driven up the private sector and its contribution to GDP growth quite strongly. If that continues, that means that we'll have quite strong GDP growth. How much that'll flow through to wages and the broader economy remains to be seen, but ultimately that kind of supports a fair amount of underlying conditions at the moment. Population growth has stabilized a fair bit. There was quite a lot of volatility coming out of COVID, particularly when you look at New South Wales and other major states of Australia. So what we're looking at the left here is the annual population growth of the ACT, New South Wales, and Australia in the dashed grey line. And as you can see, ignoring ACT for a little bit here, but particularly New South Wales and Australia, there was quite a big drop off when COVID happened. We saw a fair amount of exodus in terms of net overseas migration, and that caused quite a big drop off in terms of population growth within Australia. We saw that rebound quite recently, as you can see by the spike at around 2024 here on the right side of the graph. And we've seen that come back down and settle a bit more towards what is kind of the long-term population growth average. So it was kind of a lag in demand in terms of population growth that rebounded quite strongly. And we saw, a lot of price growth within dwelling demand and a lot of price growth within dwellings and those sorts of things. And that's kind of stabilized back to what we kind of expect normal levels to be in terms of 2019 to 2000. When you look at the components of population growth on the right here, New South Wales struggled for quite some time in terms of net interstate migration. So that is people moving from other states of Australia into New South Wales. What tends to be happening within the state is that there's a lot of people that go from New South Wales and move to other parts of the country. In ACT, that has kind of like chopped and changed over time. Right now, we're seeing a bit of an exodus out of the ACT from net interstate migration. So within New South Wales and ACT, we're kind of seeing a lot of people leaving and moving to other states of Australia. Net overseas migration, that has kind of reached a more stable level recently. Whereas when we look at natural increase, that's kind of slowly started to diminish as a contribution to both of these population growth. And that's kind of more reflective of Australia's aging population more generally. Looking at house prices now and the established market, New South Wales has experienced a bit more moderate growth, with Sydney lagging the national growth, and Canberra as well. Canberra's been a bit of a slower growth market as of recently, but Sydney in particular has, since 2020, has been about the same. Both of those have kind of lagged the national average, whereas rest of New South Wales or regional New South Wales has kind of been a little bit above that national average, as you can see on the left graph here. When you compare Sydney to some comparison cities, being Perth, Brisbane, and Melbourne on the right, Sydney is well and truly underperforming compared to Perth and Brisbane that have experienced really, really strong price growth due to strong population demand, mostly driven by growth in interstate migrants and strong overseas migration as well. But when you compare Sydney to Melbourne, Sydney's price growth has been a little bit more positive than Melbourne's, and similarly with Canberra over that same period. Melbourne's been quite flat over that similar period, whereas Sydney and Canberra Sydney in particular has experienced some modest price growth. Canberra's remained relatively flat, at least since 2022. And the main driver behind those sorts of pullback in prices or flattening of prices is in Sydney has been that house price growth over the last 12 months or so has actually come off quite a bit. That's happened in the last 6 months or so nationally, but those signs were starting to occur a bit more in Sydney prior to that point. We're in a bit of a period similar to 2022 when interest rates rose in Sydney on the left plot here, and we saw a pretty big drop off in the short term before we returned back to a bit more of a longer term, medium term sort of price growth trajectory. And we're kind of seeing that right now in the Sydney market. Canberra's remained pretty flat for house price growth and similarly for unit growth. When you compare them to nationally, they were both outperforming until 2022, the national average, and have both since, in terms of houses, and they've both since come off and dropped below those. When you look at units, Sydney's had a bit more modest gain in terms of unit price growth um, over the last 6 years. And that's the main driver of that has been mostly affordability, and things like the 5% deposit scheme from the federal government. So the availability of houses within those price ranges that people can afford or that schemes require of them is a lot more skewed towards units than houses within that market. So we're actually seeing a lot less demand for those house prices, particularly at the higher end of the market. But when it comes to units, we're seeing like modest growth in that sort of area and modest growth in demand in that area. Nationally, units have lagged houses, and that's kind of the same across Canberra and Sydney, and something that we kind of see more broadly in areas, except for really in Melbourne. The high end of the market, as I said before, that's really been a bit of the drag in the recent times. So what we're looking at here on the left is Sydney's house price growth by price tier. So the high price tier, the medium price tier, and the low price tier. And Sydney traditionally kind of the higher price tier outperforms quite um, regularly. And what we've kind of seen is up until the last 12 months, there's been quite a big drop off in the higher end price tier, a modest drop off in the middle price tier. But when you look at the low, it's remained quite flat, even with higher interest rates. And it's even had a little bit of growth to get to that point with higher interest rates and current policy shifts. We're actually seeing that lower end of the Sydney market remain quite strong relative to what's happening elsewhere within the Sydney market at the higher medium end. Similarly, that's happened in Canberra. The lower end of the market's been quite flat and modest growth until that point. But we've seen, at least in the last 6 to 12 months, both the high and the middle end of the market have actually come off quite a bit. And that's been a bit of the story nationally. But interestingly, in other markets, the lower end of price tier has actually outperformed both the high and mid compared to what is happening in Sydney and the ACT. Looking over to rentals and rental availability, it has improved a little bit since the start of 2026 and is about higher or as high as what we've seen in 2025. So on the left here, we see the rental vacancy rate for Canberra, Sydney, and the rest of New South Wales. There's been strong improvement in Canberra in recent times, similarly in Sydney and the rest of New South Wales. Part of that is a bit of seasonality, but early data shows that we're kind of just outstripping that seasonality a little bit. And whether that's going to continue or not, or at least remain elevated above recent seasonal trends, remains to be seen. And we'll wait and see what the data kind of says. But when you look at it compared to comparable areas, so Sydney and Canberra compared to other capital cities, they're sitting slightly above Canberra, other capital cities, what we're looking at on the right here. Whereas the rest of New South Wales, compared to other regional areas, it's kind of sitting slightly below the rental vacancy rate of regional areas of the rest of Australia. That means there's a little bit more pressure in that sort of market compared to other regional areas, and a little bit less pressure in Sydney and Canberra. But ultimately, these vacancy rates are still very low when you compare it to 2019, 2020, particularly in New South Wales, not necessarily particularly in Canberra. But what we're seeing is in those markets is anything below 2% is considered high rental stress, and we're still well and truly below that 2% nationally. And any sort of improvement is welcome relief for renters, but ultimately anything below 2% is still pretty high rental stress and will mean rental price growth in turn. Sydney still leads nationally in terms of rents, and that's kind of been the case for quite some time. It did occur during COVID where there was actually a bit of a drop off, whereas there's been a strong rebound ever since. So since 2022, you can see on the left here in the red line, Sydney's had really strong price growth in terms of rents, and as demand came back online, as restrictions eased, has been quite strong. Canberra has had quite modest price growth in terms of rents, and it's been a lot slower than what we've seen in Sydney, and we're actually seeing quite a closing of the gap in terms of rental prices in rest of New South Wales and Canberra as it was in 2019. So there was quite a large gap in 2019 between the two regions, whereas now they're coming pretty close to one another. When you compare that to capital cities, so Sydney and Canberra's kind of a little bit below the capitals, and that's more broadly aligned with how they've had slower growth over recent times in terms of rental prices, whereas Sydney's well and truly above its peers and kind of leads the nation still in terms of rental prices. Western New South Wales kind of sitting on par with regional areas around its current rental price, asking price. Listings activity across Sydney and Canberra, looking at how we're kind of tracking in terms of listing activity on REA. 2026 is kind of on par with what we saw in 2025. So there hasn't been any sort of signs as yet around demand to sell and demand to list. In terms of it's sitting still above the average that we saw in 2016 to 2024, and remains like broadly aligned with where we kind of like would expect listings activity to be. Properties that are selling below the asking price, so looking more towards the selling side, we're sitting slightly above in Sydney and Canberra, above what we kind of expect to be the long-term average. So what we're looking at here is the share of homes that are sold below the initial asking price. So Canberra in the purple line and Sydney in the red, you see a little dotted line going horizontally across two of those lines across that plot. So the red line, that's essentially Sydney's long-term average, and the purple line, that is Canberra's. And what we see is we're a little bit above the long-term average, but in terms of the last 2 to 3 years, both of those markets are still kind of where they've been quite recently in terms of selling below the asking price. When you compare that to nationally, we're still a fair bit below the long-term average. Yes, there's been quite a strong uptick as interest rates have started to increase from the start of the year, and since we've had policy changes to the tax system that has seen quite strong growth in that. Sellers tend to like hold off a lot more, and there's not as much liquidity in a market like housing as you kind of tend to see within a stock market, where you can see those sorts of changes occur quite rapidly within the sort of buying and selling. And obviously we've seen quite a big uptick, but it's not necessarily anything more dramatic than what we saw when interest rates increased in 2022 at this point in time. And nor do we necessarily expect it to be anything more dramatic. There'll be the initial shocks kind of occurred, and over the short term, yes, there will be a decline or softening of prices, but ultimately we'll kind of reach an equilibrium between buyers and sellers, and the underlying fundamentals will kind of return where demand currently exceeds supply. Looking at investor activity and budget changes now, and we've talked about the government policy shifts, and they'll likely lead to a higher proportion of owner-occupier sales over the short term. And we're expecting that particularly as investors pull back. And that's kind of like a bit of a key idea behind the government's policy. And that's what we'll see at least over the short while. The aggregate amount that we might see in terms of sales will probably have some sort of pullback in the short term as there's a bit of a repricing within the market. But ultimately, we expect long-term trends to kind of return. Looking at the budget changes, the capital gains taxation, it'll switch back to a new discount methodology, reverting back to the old indexation model, which we saw in pre-1999, which essentially means that the financial year 28 will flick over to indexed gains, which essentially means you'll only ever be taxed on the real gain that you make on an asset. Combined with this, there will be a minimum marginal tax rate of 30%, and that minimum marginal tax rate is more to reduce the effect of strategic realized gains that occurs in other asset types. So things like shares, where people will purposely sell over time so as to pay a lower tax amount. That doesn't necessarily tend to happen as much in property. And if you're a working aged person that is selling an asset, an investment property, that minimum tax rate essentially won't really affect your tax return. The thing that will affect it more is potentially the switch of the discount methodology. When the transition occurs to the new methodology, any unrealized gains can either be assessed at value at that point in time by a valuer, or that proportion of the gain will essentially be any future gains from that point will have an index, will be indexed, and the gain up until that point will take a 50% discount, or you can essentially claim a pro rata when you sell as a share of holding time. So take 5 years. So say you hold a property 5 years until the July 1, and then you sell 5 years after July 1. Essentially, half of your gain, if you make a gain, will have a 50% discount applied to it, and the other half will have the indexation. New builds can choose between the two discount methods, and principal place of residence is still CGT exempt. Negative gearing has shifted from deducting losses against current income to deducting losses against future property income gains. And that's for established properties. And there is the ability for people with property portfolios to do that across the portfolio. So it's not just within a one asset holding. You can actually do that across if you have multiple properties. So those investors that hold a few positively geared properties right now can still purchase a property, an investment property in the future. And if they're making property gains, property income gains from those assets, and they're no longer negatively gearing, they can actually offset those income gains against any sort of payment that they're making, any loss payment that they're making on a new purchase. Commercial property and new builds can still access the old negative gearing rules, and purchases prior to budget night are still able to claim negative gearing. AUSTRAC's anti-money laundering has been expanded and to real estate agents, and the regulatory requirements for that are quite relatively extensive. And but ultimately, real estate agents just need to verify the client identities and assess the financial risks that are going on and report anything that it seems to be suspicious. And that's to prevent money laundering within the real estate market. Looking at the CGT discount, it's important to think about the CGT discount changes as more technical than arbitrary, and they can sometimes favor certain residential investors over others. So what we're looking at here is the residential property investor capital gains treatment in Sydney, looking back until 2014. And essentially, each quarter, we've taken the proportion of investor sales when they've made a capital gain and whether they would have paid a lower tax bill under the indexation method versus the 50%. For the majority of time, the 50%, yes, they would pay a lower tax bill. But ultimately, that hasn't been the case for all investors. And particularly in recent times, it's gone closer to 60-40 in the last 3 years around whether you actually pay less capital gains tax under the indexation method versus the 50%. So it really depends on how the market and inflation moves as to whether the indexation method actually is more beneficial to an investor versus the 50%. The general rule of thumb is indexation to be better than for 50% discount to be better than indexation, your capital gain needs to be your annual capital gain needs to be twice the rate of inflation, is kind of the general rule of thumb there. Investment activity has been quite a strong component of the market, and that's kind of the case nationally that we've seen up until quite recently. So this is new investor loans in New South Wales and ACT, and this is until March of this year. And up until then, we were kind of at a near peak and had grown quite a lot since 2023 when we saw the bottoming out from higher interest rates, from the hiking of interest rates. So that's probably expected to come off over the short term quite a bit. And we'll probably see some sort of return over the medium to longer term of investor loans within the market as yields rebalance and we kind of reach more of an equilibrium and investors want to return. We'll also probably see some sort of incentive on a relative basis where investors will skew a little bit more to new builds if that appetite is there and the yield/capital growth potential that they're trying to gain out of it is available. Ultimately, those higher level of investors means that there's actually been an increase in the number of investors' share of new listings. And that's kind of been a general trend in Sydney and the rest of Australia since about 2019. So what we're looking at here is the share of listings on realestate.com.au that are actually investor listings. So the red line is Sydney and the black line is the rest of Australia, not including Sydney. And what you see is there's been quite a general trend since 2019 where that's been going up. And that's in part because we've actually had a larger share of investor buyers into the market. Recently, as you can see, since the start of 2026 and increase again when the budget changes came out, we've seen quite a big uptick in the number of investor shares, the share of investors per the share of investors of new listings. That's ultimately probably going to be the case over the next short term, that investors are going to take up a larger proportion of for sale listings. But ultimately, that might not be the case going forward, as if investors can't gain the price that they want on the market, they might hold on to the asset and reevaluate what they're going to do with it. And that may be putting it up for rent or trying to do some sort of other activity with that property, be that potentially listing it in some other way. Moving over to Outlook here. Ultimately, supply still lags demand, and Australia isn't actually building enough dwellings to match what we need to. So we have a national cabinet target of 1.2 million homes to be built over 5 years, and that target was essentially 60,000 new dwelling completions over each quarter of the year. Separated by state, so New South Wales, that was 18,600 every quarter to be built. And ultimately, as you can see on the left for Australia, we're quite below that mark. And on the right for New South Wales, we're a fair bit below that mark. And that's kind of going to continue. And that's just more of a structural constraint within the economy and within our capacity to build new homes, and mostly around current regulations and cost to build. Ultimately, that supply isn't going to meet the demand that we currently need, nor is it going to meet the future demand that we'll need. So that in turn is going to put upward pressure on prices over the longer term. Looking at interest rates now, and what we're looking at here is the cash rate over time, the red line, and a few forecasts from Westpac, the RBA, and market economists in the dashed green, light blue, and purple line. Essentially, the cash rate and where we expect it to go from here, a lot of economists disagree about where it should go from here and what the RBA should do. Ultimately, inflation data is probably going to determine who's going to be right. But when you look at it, Westpac's a bit more of a pessimistic view in the sense that they think that inflation, as we saw before earlier in the slide around domestically driven inflation, is still really, really sticky. And the role of the RBA is to essentially make sure that is anchored back to the target band. And to do that, they need to increase interest rates. Market economists, they tend to think we're already in a pretty contractionary stance and the economy's slowing enough that if we just hold for longer, we'll kind of meet that target again and it'll all be fine. At about mid-2027, everyone kind of agrees that we'll end up cutting rates as the inflationary problem kind of comes under control and we need a demand to return to the market. And we'll kind of reach what is referred to as the RBA's neutral rate, where kind of inflation is right where it wants to be and we can spur more growth and employment in the economy. Ultimately, there's a fair amount of noise in the market at the moment. And as I've kind of shown around the population growth and particularly the supply, the fundamentals still remain the same. And ultimately, REA, we expect that price growth will return in 2027. And in some markets, it'll just be a bit softer for the rest of this year. And essentially, we expect places, Sydney and most of the capital cities, and to return to growth over in 2027. And pretty much over the long term, albeit a bit more modest growth than what we've seen in markets like Brisbane, Adelaide, Perth in recent times. Thank you very much. I hope you enjoyed this session.